and all the other things that we've been talking about, because everything is correlated. Everything that we've talked about is going to be used in the next slide. So it's very important you make notes. Now, using dynamic risk versus static risk, how to cut losses short, and understanding lower time frame market structure. This is really important. I have used the lower time frame market structure to my advantage to cut losses short. In the past 3 months, I've increased my lot sizes, but at the same time, I've also successfully cut my losses short as well, and it has worked a lot. It has worked in a lot of good ways. So we're going to take a look at that here. Um, let's say you have a resistance, right? You have a resistance and you have a candle going bullish. Now, if someone is looking at this and they say, okay, well, if we have a candle going bullish, now we're waiting for a candle to go to turn bearish so that we can take a sell, right? Like the only reason we look at the candles at like certain zones is to know if we can take buys or sells. If someone is having issues on YouTube, I think if you try to log into Zoom, it might work. So basically now if you have a candle closing bearish and someone can say, okay, hey Raja, since what I've learned so far, I know that, okay, since now this candle went bullish and now we have a candle closing bearish, there's a high probability for the next candle to continue down, right? If the next candle has to continue down, something like this, you need to take a sell right over here and you need to place a stop above the previous candle's high. That's where we place our stop losses, right? We place our stop losses above the previous candle's high. So let's say someone says, okay, well, I'm going to put my stop loss up over here and I'm going to use 3% risk. Now, there are two ways to go about that. One way to go about that is to use static risk, right? If you're using static risk, you're placing a sell over here and you are now saying that, okay, this is my 3% risk. Right? If price comes up and hits my stop loss, I'm going to lose 3%. But as you move on the trades and as you get more experienced and as you try to understand market structure more and now you want to get more advanced, you might say, okay, well, I'm going to use a dynamic risk. So what that basically means is that someone might turn around and say, okay, well, if I'm using 3%, I might want to enter the first sell at 1%. Right? And if, let's say, price starts moving bullish, I might want to add another 1%. I might want to add another 1% right over here, right? And now you have a total of 2% running. This is dynamic risk now. Right now you have 2% running and your stop loss is the same. The benefit of this, I'll tell you what's the benefit of dynamic risk. The benefit of this is, like, let's say if you have 2% running and for some reason the next candle just starts to move up and takes you out, if it hits your stop loss, you've lost 2%. You haven't lost 3%, but you've lost 2%. Now your risk was less. You used risk to your favor, right? But at the same time, what happens now is that, let's say price moves up a little higher and if you're still confident price is going to go down, now you can add your other 1%. Right? Now you've added your entire 3% risk. So once you've added this, and once price starts moving bearish, now you can say, okay, I have 1, 2, 3 positions running, and each position is at 1% risk for simplicity. Now you can say that, okay, maybe now I want to close this position, and I want to close this one, and I'm only going to leave one position running. So if you have issues let's say if you use one position and if you want to know the advantage of using multiples with dynamic risk, this is the advantage. Now you can easily close 2 positions and you can let one run with stops at break even. Now it's up to you whether you want to put stops including the spread, commission, whatever. Me, personally, I don't go into those details. I just put stops at break even. I'm willing to eat the spread. It's okay. It's whatever, right? So it's really important. Dynamic risk management is you're breaking down your trade into multiple percentages and then you're taking the trades. In static risk management, you're just keeping the risk as it is. It's really important. Now, in the same aspect, when we talk about Oh, I don't know if you can or will slow the meeting, but can you explain that again? Okay, so I'm going to explain this again one more time. Now, let's see, or actually, let us continue to the next example, and then we might, make this concept much more clear. Let's say we have a support, right? We have a support, and candle came bearish. Wouldn't you open the position once the new candle passed the previous low? Okay. We're only talking about what we're talking about right now. If you want to talk about some other topics, please, let's just stick to what we're doing right now. This presentation, I've built it with a particular structure in mind to help everybody. So let's not deviate from topics. So let's say you have a support, right? And candle is coming down towards support, it's bearish. And based on what we've learned, we're like, okay, if let's say this is a 1 hour support, right? And someone is saying, okay, if the candle has closed bullish, now there's a high chance that the next candle might continue going bullish, right? So if you think that the next candle is going to continue going bullish, now someone can say that, okay, I might want to take a buy and I might want to put my stop loss below the previous candle right over here, right? Because for price to continue up, we want candles to respect the lows in uptrends and we want candles to respect the highs in downtrends, right? So for this candle to continue bullish, it has to respect the low of the previous candle, right? So that's why if someone wants to take a buy over here, they might say that, okay, I'm going to take a 2% risk in this trade. I'm going to take a buy, and if price hits my stop loss, I'm going to lose 2%. Please, if someone is in here who wants to move the stop loss like down over here, don't do that. You're placing stops below the candle lows in order to say that, okay, if price has to move up, it has to respect the low of the previous candle. If the next candle breaks this low, then that means now the buying idea is invalid. That means now price may start moving, let's say the next candle forms like this and it stops you out. Now this means that the next candle may start moving bearish, right? This is why we have our stops below the lows of the bullish candles, right? So the first risk is static risk. So let's say someone who's new and they're like, hey, I'm not comfortable in opening multiple positions, but what I want to do is I want to open one position with one static risk, which is going to be 2%, and that's it. If price goes in my favor, I'm going to make money. If price goes in my stop loss, I'm going to lose 2%, and that's my plan. But as you go along, as you start taking more trades, as you start understanding more of the risk dynamics, you start to realize that, okay, well, instead of using 2%, I might want to open 1%. I might want to open 1% risk right over here. Because if price retraces, or if price, let's say something happened that price just goes down and it hits my stop loss, I want to lose 1%. I don't want to lose 2%. I'm going to wait a little bit. All you can say is that, okay, I'm going to put 1% right over here. And if price retraces, and if I still believe as long as this low is respected, and I still believe price is going to go up, I might want to add another 1% right over here. Right? And now you have two positions opened at 1% each in total of 2%. Now you're using dynamic risk. Now, if let's say price from here starts moving, let's say from here, price now starts moving bullish basically. So now you are in profit. So now you can say that, okay, now since I have two positions open, maybe now I want to close one position and let the other one run. Right? Because if you have a static risk, if you only have one position open, then it's a little bit of a hassle to go to your MetaTrader and right-click the position and manually close half. It's a little bit of a hassle. So, I mean, if you're experienced enough, if you think that you can handle risk, I would say go with dynamic risk. We can only use dynamic risk on MT4, right? Can we disable dollar? Yeah, you can use dynamic risk on MT4 and MT5. It's operational on both. So that's how you make sure you're using dynamic risk and static risk. So the idea is to never let price stop you out with your complete risk. That's the entire idea. The only reason slowly you're going to move towards dynamic risk would be that you would never want to get stopped out with your entire stop loss. This method takes experience and practice. Dynamic risk is extremely useful when the probability of the outcome is low and you want to enter with a lower risk. So when you're using dynamic risk, you're breaking down your complete risk. Let's say you're going to risk 4% per trade. Right? You see an opportunity and you say, I'm going to risk 4% per trade. But at the same time, you're like, yeah, I'm going to use 4%, but I want to break it down. I want to break it down to maybe 2 positions of 2%. Right? So that's useful. It's always best practice to reduce risk when you're unsure. Do we have any question related to this so far? Only this. Not breaking lows or highs, just this what we discussed. Okay, perfect. All right, so let's continue on to part 2. Part 2 of risk management 3.0 is how to effectively cut losses short, right? So if you have a buy, right? If a buy trade is executed on the 1 hour or the 30-minute, right? If a buy trade is executed on a 1 hour or 30-minute, we expect candles to continue making higher highs and higher lows, right? So just understand this concept first. Just understand this concept. If we think price is continuing bullish on the 1 hour and the 30-minute, we want candles to make higher highs and higher lows, in the anticipation that as long as the candles close in our direction, the trade should be valid, and vice versa for sell. As long as candles keep on closing bullish, or as long as candles keep on respecting their higher highs and higher lows, this means now price should continue going our way. Now, in the other way, if a smaller time frame candle starts closing in the opposite direction or breaks the low of the previous candle, then there's a slight chance that the preceding candle might start going against you. What this means is, let's say you have a candle that's closing bullish. Actually, we're going to look at this example here in a bit. This is when you decide how to manage risk by closing a percentage of the position. This will eventually, so when you're reducing risk, right? Let's say if you have a candle open and the candle is going bullish and you're in a buy and it's say a 30-minute candle, but let's say on a 15-minute candle, you see that the candle has closed bearish, right? So now what you want to do is you want to reduce some risk. What I like to do is I like to take off 50% of the position away from the risk. What this does is this basically reduces your risk in a possible losing trade, right? Let's say if a smaller time frame candle closes against you, then there's a higher chance that the next one can go against you as well, and then ultimately your stop loss might get hit. So if you reduce risk, you can eventually reduce the risk in a possible bad trade, right? In the same way, you can remove some stress. Sometimes what happens is that when your position goes in a drawdown, some people get anxiety, some people get stressed out that, hey man, I'm going to get stopped out again. I'm in the drawdown. So when you close percentage of the position, you're essentially removing stress, because sometimes what happens now, this has also happened to a lot of guys and gals here, is that when you're in a buy and you go in a drawdown and you get afraid, you get afraid that, okay, price might hit my stop loss, and you close out everything, and then price goes into your favor and you're like, oh man, I should have held my position, it went in my way, it always happens to me, I don't know how to fix it. So the way to fix it is when price goes in drawdown, and if you still think it's going to go in your favor, but at the same time, if you're still afraid, just close 50%. Let it go. Close it out so that you're still in the trade, which means you're still in the game and you're not worried about losing the trade, right? What something else is going to do is now you're not going to have to worry about the trade as well, because now not only you've reduced the risk, but you've also reduced the stress. Now, even if you've taken off 50% loss away, if price still hits your stop loss, you're going to be okay with it. You're going to say, well, if it goes my way, I'm going to make money. But if it hits my stop loss, it's a good thing it's not going to hit my complete stop loss, right? Makes sense. You want to really reduce your stop loss. And it's also going to increase your confidence too, because most times this has happened to me. Now, I used to close trades when they would go in drawdown, and I'd be like, oh man, I'm afraid. I'm afraid this might go in drawdown, so I might want to close the trade. And I would be closing 50%, and when I would close 50%, price would go my way, and that increased my confidence. That gave me the confidence to the next time, maybe letting my entire position open based on what I've seen before, because I've seen it work before, so it has to work again as well. Now, looking at some examples, let's say we have high time frame here on the left hand side, and then we have the lower time frame on the right hand side. So when we have these two issues on the left and the right, what we want to do is we want to see that, okay, let's say we have a support, right? We have a support and we have candle that's going bearish. Let's say this is the 30-minute candle, right? The 30-minute candle is going bearish and the next 30-minute candle goes bullish. Now, based on what we've learned is that since if the 30-minute candle encounters a support and it's closing bullish, there's a very high chance the next candle is going to go bullish as well. So we take a buy. Let's say someone says, okay, well, what we're going to do is we're going to take a buy right over here, and we're going to anticipate the next candle to continue moving bullish. Makes sense, right? This is what we learned. Now, when we look at the smaller time frame and we break down this bullish 30-minute candle into two 15-minute candles, just say yes, that this is what we will see, right? Based on the 15-minute, if we break it down to 30-minute. Yes? No? Yeah? Yes. Okay. Perfect. Yeah. Yeah. So that's what we're going to see. Now, when you see this, now you're like, okay, well, maybe if the next 15-minute candle goes bullish, that will mean that the 30-minute candle has to go bullish. But sometimes what can happen is that you might have a 15-minute candle that starts breaking the low of the previous candles. So what we learned in an uptrend and downtrend was that for an uptrend to continue, for these candles to continue moving bullish, you need the next candle to start respecting the lows of the previous candles. But if this 15-minute candle has broken the low of the previous 15-minute candle, this means that maybe the next 30-minute candle is starting to form like this, bearish. So if it's starting to form bearish, and if your stop loss is down over here, now you have to decide whether you want the position to be open or you want to close a portion of that position, right? Now what you have to do is now you're going to say that, okay, what do we have to do now? What do we do now? Do we close a percentage to make sure, like let's say if the next candle, let's say the next 15-minute candle forms like this, right? Just because the one before that broke the previous low. So now what if this happens, right? So at this point, if you would have closed 50% and if it hit your stop loss, you've lost less than what you plan to lose, right? But if you haven't closed 50%, now you've lost your entire stop loss. Let's say your risk was 2% and you were risking $50, then now you've lost $50. But when the candle closed bearish like this over here, and you close, let's say, partial, and it hits your stop loss, now you've lost maybe $30 to $35 instead of losing $50. Make sense? This is how you're reducing your losses, right? You're not giving price the opportunity to hit your stop loss at the entire position. You're letting price hit stop loss at a portion of your position. This is really, really extremely important because I get too many questions saying, hey man, I'm getting my stops hit and when my stops hit and when I make profits, I'm at break even. What do I do? I have a good win rate, but my wins are just a little above my losses, I don't know what to do. So this is what you need to do. Whenever you're taking losses, you're taking 100% losses. You're not taking a portion of the loss. So I always take a portion of my loss out. Because if I'm using a 5 lot or a 10 lot, I don't want to lose $1,000. I want to lose maybe $700. Or if I'm using a 5 lot, I don't want to lose $500 based on a 10 pips stop loss. I want to lose maybe $300 or $250. because I want to close percentage when I see that, okay, there's an opportunity that price may start going against me. So really important. There's a question here. But let's say if it goes on drawdown and we close 50%, but then it comes back to our entry and it might in profit, should we enter again with position? So basically the question is, what if we close 50% in drawdown and then price starts going our way? Can we enter another position? That is an advanced concept, and we're not going to talk about that right now. We're going to talk about that next weekend because that's a little advanced. I'm still working on how to correctly present that. But the one thing I'm really focusing on is how to cut your losses short. That's really important. Should we wait? Should we wait for the candle to close and once break to 50%? No. So I hope this makes sense on how you're cutting your losses short. You're basically looking at the smaller time frames, the 15-minute time frames. You're looking to see if they're breaking the lows or not. If they are breaking the lows or the highs, then there's a very high chance that the price may moving against you. So whenever you're in a trade based on the 1 hour or the 30-minute, you're constantly looking at the smaller time frames to see if they are turning against you or not. If they start turning against you, me personally, I'm taking percentage positions off. So points to remember is basically there's no rule on how much percentage to close. It's personal preference. It's up to you whether you want to close 25%, 50%, 75%. That's totally up to you. My rule of thumb is I close 50%. With practice, you will reduce losses significantly, and I can promise you that. As you practice more, I would say if you're a new trader, just keep this in the back of your mind. Whenever you see a smaller time frame candle going against you, just look to see, okay, how can you reduce the loss, or how can you maybe alleviate some stress? Because drawdown is stressful, man. Like when you're a new trader and you have $1,000 account and you're in a $15 drawdown, it's stressful. So you want to take off some percentage, 50%, 75%. This is really important. Trading is all about how to conserve losses. Trading is not about buying and selling. Trading is about how can you reduce your risk. Risk mitigation is really important in trading. That's one of the main cornerstones of trading. Always be aware of candles closing against you or breaking the lows or highs of previous candles in uptrends or downtrends. Right? Always understand, are the smaller time frame candles are still in uptrends or downtrends? Are they still respecting the lows of the highs? If they start breaking the lows of the highs, then you need to be very careful. Then you need to say that, okay, well, maybe price is not doing what we expected it to do, so maybe we want to close something here, or we maybe want to secure some risk so we don't take a whole loss. This is really important. It's going to help you with your psychology a lot too. The goal, again, is to conserve capital. Keep it safe and don't fuck up. A lot of people, what they do is when price goes in drawdown, they add a higher position. They add more risk. At that point, you are fucking up. You don't have to fuck up. Trust me. Don't use higher risk when price goes against you. When price goes against you, look to see how you can reduce the risk rather than increasing the risk. These are really important things. Two very different ideas. When you're new, you want to add risk saying that, oh, no, it's still going to go up. But when you're experienced, you start to look at, okay, it's coming against us. How can I reduce this risk? If it hits my stop loss, how can I reduce this risk? If it hits my stop loss, how can I make sure I take a less of a beating rather than a heavy beating? Do you cut your losses based on the 15-minute? Yes. So your rule 15-minute breaks the high or low? Yes. If you are using dynamic risk and price never puts you in a drawdown, but instead instantly in profit, how would you add more positions? I don't. Sometimes, price does what it does. Sometimes, if I'm using dynamic risk, sometimes, I've used a one lot on a buy and that has just shot up 30, 40 pips. It is what it is. You can't do anything about it. So we only trade on the best possible scenarios, and the best possible scenarios are where candles will, let's say you have a bullish candle right here. It's not letting me draw a bullish candle here. Let me see if I can. Okay, so if you have a bullish candle like this, oh, let's say if you have a bearish one, right? Let's say if you have a bearish candle like this, a perfect scenario is going to be that you would take a sell over here, price will retrace, create a wick, you will have another sell over here, your stop is going to be up over here, and then you're going to have a wick fill and a continuation down. This is the perfect scenario of a trade. This does not happen all the time, you know. So sometimes what may happen is that you might take a sell right over here and candle just drops. It is what it is. You never got a chance to enter more positions. It's just how it is. Didn't you say add another percent if you still believe your trade will work out? Yes, you can still add, but that's advanced concept. You have to watch it happen over and over again. You just can't do that. You know, so what I would recommend, if you're a new trader, I would recommend just using one position. You know, it takes a lot of experience using dynamic risk. I'm going to say it again. I wasn't going to add this topic because there are a lot of new people coming in, and I wasn't going to add it because it's a little advanced, you know. So this will take experience of you watching charts, watching candles move, and then slowly you're going to start to learn that, okay, how to use dynamic risk. It's like riding a bicycle with training wheels, and then when you see your buddy riding the bicycle without training wheels, then you want to do the same, but you know at this point you're not at that level to do that. You know, so it will take you time. So for now, we will just focus on how to cut losses short when the smaller time frame candles, they start moving against you. So after we're done with the webinar, you can watch it over and over again, because once you watch it 3 or 4 times, you start understanding things much more better. So let's move on here. We have a little break time. I actually need a little bit of a break here. So let's answer a little question here.